Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
On the other side of the coin, if we have a bias where the underlying security is maybe going to trade sideways or up, we're looking at creating what's known as a bull-put spread. So, of course, our outlook is bullish. We're going to sell the put at a strike price below the current pair value, and we're going to receive a credit. Now, ultimately, we're going to purchase that a put option below the sold strike price to limit our potential losses. The cost is subtracted from the credit we've received, and if the pair value in this case stays the same or goes up, we keep the credit. So let's take a look at the CDD. What a wild ride for the U.S. Canadian dollar over the last few days. The idea, though, is that we have been looking at and have identified a very important support level, or what's now support, but what was a resistance level within this 102 zone. So we can see here that the pair, in this case the U.S. dollar, made a huge move beyond that resistance level and is now settled back in around that support. Now, we actually saw it dip below that today, so recognize these are charts based on yesterday, but we closed back above the 102 level, around 102.20. So the idea is that this now is a support. Once again, somebody who was looking at the CDD prior to this big move that took place and said, the U.S. dollar is going to stay below 102 here. The Canadian dollar is strong. It's it's this, it's that. Whatever the rationale is, I'm going to just go in and I'm going to sell some call options on the CDD or what have you. Recognize that you're getting tested and your account is getting stretched to the limit as the pair value jumps from 103 all the way to 108 within 1 day. That's a 5-point move in the in this particular index. That, on a naked call position, can get a little scary. Right, so the idea is that we're going to use that additional option contract in order to make sure that we have that identifiable risk exposure. Now, in this scenario, I'm talking about now creating a bull put spread, because my outlook is that this, what was once a resistance level, is now going to act or should act as an important support level. So the belief is that we're going to see some consolidation above 102 and perhaps maybe now a little bit of a continuation in strengthening of the U.S. dollar against the Canadian dollar over the next little bit. Of course, time will tell, but the idea is that if that is my outlook over the next month, what I can do is I can get in and I could sell some put options. Now, the other way that I could look to identify this as a support level is, once again, just use my fib retracement tool. So you can see here as well, I'm taking this low from down in here. I'll just use my arrow to identify that. I'm going to take this low here and this high here, and I can see that right now the pair is trading in and around that 61.8% retracement. So the way we look to utilize fibs is that the 61.8 becomes a very important support level. Now, that's not to say that we don't get and we're not prepared for these kinds of anomalies here. So we have to recognize that all of these measurements and all of these support and resistance levels that we're identifying, we're basing them on probabilities. So while we believe and we're prepared to trade with the view that those support levels are going to hold, we have to understand that there's still risk. So if I felt that the market, that the CDD was going to stay above 102, I can sell 102 strike put options. But I also have to keep in mind that we live in crazy times. We don't know what's going to happen from a day-to-day basis. if I want to cap my risk exposure, I have to decide on which option contract below that put option is best suited to create that little protective position on the spread strategy. So let's take a look at an example here by just kind of breaking down a bull put spread. So in this case, as I mentioned, I believe here my outlook is that the CDD over the next, from now until the third Friday of June, is going to remain above 102. So what I want to do is I want to sell 10 of those put options, and I want to collect $1,290 or $1.29 per contract. Now, as I mentioned, the reason why I would look to do this is that I believe that these options are going to expire worthless, and I'm going to collect the entire premium. Well, I have I have an unidentifiable risk exposure. Well, my risk exposure is of course zero on the CDD. But right now, if I sell a 102 strike put option, no matter how low the CDD drops in value, I'm obligated to cover that position at 102. So what I need to do is I need to create an identifiable risk exposure. So I go out and I take a look at the lower strike price, which in this case is one strike interval away down at the 101 level, and I'm going to buy 10 101 strike put options. That is going to cost me $1.02 of my entire premium. Now, keep in mind, if I wanted to keep more of this premium, instead of the 101s, I could go down and I could buy the 100s. Now, what that means is that my risk exposure has now spread an additional 1 point, because now I'm responsible for the difference between 102 and 100. Yes, I'm keeping more of my premium, but again, my risk exposure has increased because I've chosen a strike price that is in fact 2 strikes below my sold option, not 1 strike. So again, we want to find that happy medium. In this case, we can see that our maximum loss is identified at the strike spread, which is 1 point, minus the credit. In this case, we're looking at the 1 point interval between the strikes, between 102 and 101, and we're subtracting, of course, the 27 cents, and we're coming up with a maximum risk exposure of $730. Our break-even point is going to be the sold strike price, which is the 102. Subtract the credit. So as you can see here, we've got 101.73. We've got 102. Subtract 27 gives us our break-even point. So the bottom line is we don't start to incur a full loss on this position until we see the pair value break below that 101.73 level.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.